Sajjid Chinoy, Chief India Economist at JPMorgan, now joins us live. Sajjid, good morning. I was reading your note today, and you say that the hopes for GST are rising as far as the deadlock for GST is concerned. You think markets has already priced in that the GST would go through in the next session? So if it doesn't happen, it will be a big disappointment?
I'm not so sure. It's hard to always extract what markets have priced or not because there are so many different elements that are simultaneously considered when prices move. I think, in fact, the risk could be the other way. Markets have understood that this is a difficult political sort of deadlock that's governed the GST over the last year. I think that, in fact, if you don't get the GST in the monsoon session, it will, markets won't be particularly disappointed. But if you do get the GST, that actually creates upside risks, because I'm not sure markets before last week had fully expected, internalized or priced in the fact that the GST would be up and running by next April. For many years we've been told it's happening next year, and it hasn't happened. So I'm not sure markets were ready for that. If in fact this gets passed in the monsoon session, and there is a realistic chance that this may hit the ground by next April, that actually would come as a positive surprise, I think. So there's upside risk here from the GST going through. I'm not sure there's too much downside risk if things don't happen, especially if there is some movement, even if the bill isn't passed, but the lines of communication between the Congress and the government are open, and there's a sense that both sides are working towards some compromise. I think markets will not be particularly disappointed at those developments.
Sajjid, for most viewers, and frankly even for me, GST sounds like one of those magic things where that GST comes through, suddenly GDP will grow by 2%. What are the connections? How does that happen? I have not been able to work that out. Yeah. No, you raise, I think, a very important point, because I think we oversimplify the issue, right? That suddenly GST comes in and you get a 2% growth to boost. I don't think it's nearly as simple as that. I think the way to think about GST is it's a very important supply-side reform that's going to create a common market and therefore increase allocative efficiency in the economy. I think that's the key benefit, because the near-term impact on the fiscal may not be very large, because the rate that is being considered is the revenue-neutral rate. So by construction, it's the rate at which, at least in the near term, there will not be a big boost to the fiscal. The hope is that once you have a common market, as somebody joked, the GST is India's form of signing a free trade agreement with itself. Is that if you've got goods, services being completely unimpeded by different tax structures in the country, you will get more allocative efficiency over time. That has productivity benefits, and over time that will lead to some pickup in growth, and then that pickup in growth gives you some tax buoyancy and has revenue implications for the budget. So I think it's. I think the Business Standard did a very interesting story, and I'm sure you would have read that as well, because one of the things that's said about GST is octroi, entry tax. These are real hassles when it comes to movement of goods. So in China, if a thing moves within 3 days, here it takes 7 days, because at every point you have to pay entry tax. These things will go away in GST, and suddenly movement of goods, just the efficiency increases so dramatically, which reduces cost.
That's right.
Now, the Business Standard did a very interesting thing. They put a reporter inside a truck to see what really slows them down. And they found that octroi and entry tax had nothing to do with it. What was a big problem was that a truck actually wanted to go at 40 kilometers per hour, because that was the most fuel-efficient manner in which a driver could make money out of the amount of fuel given to him. So those things are not going to go away whether you remove octroi or entry tax. I'm simplifying it.
Listen, I want to emphasize again, your point is GST is not a panacea, but it is a very important reform, because, so increasing transportation speeds is just one part of it. But, today you have examples where firms set up in particular states because they've got differential tax structures that they benefit from, and don't set up warehousing in the parts of the country which would have otherwise been optimal if there was no tax arbitrage to gain from. So there are multiple impacts of GST that cannot be internalized by only looking at what is the speed with which trucks will go. So there is going to be.
Doesn't the current bill actually allow some states to do that differential tax taxation for particular industries? For instance, Uttarakhand right now gives these huge tax benefits if you come and set up. Doesn't that still allow you to do that?
Well, firstly, the exceptions are not nearly as broad-based as they are today, and secondly, there is talk about having a 1% production tax which benefits the producer states, and that's something that the Congress Party has opposed, and I think even some indications from the government are they're willing to relook at that. So of course, for GST, the less exceptions there are, the bigger the base is, that much more the efficiency benefits. But for us to say that this is binary, that on the one hand it's a panacea, it's not. On the other hand, the impact of a common market is minimal. That's not true either. Having a common market with common tax structures where firms can decide to set up shop based purely on economic criteria, distance to market, cost of production, those will have big efficiency benefits, but they will take time. This is a reform that's going to show up in growth and revenue and productivity over the next 3 to 5 years, but it is a critical reform in ensuring that we have a common market.
Sajjid, since you're here and you understand the thing and you're an expert, I'm going to keep asking the devil's advocate questions, all the questions put out by skeptics. Now, when you say that common market, to say that common market is not going to have any impact, there are some who say, yes, of course it will have an impact, in the same way in which common global markets have led to pockets of underdevelopment. So, if a producer state has access to every market in India which is non-producing, then obviously industries will continue to concentrate in producer states. And over a longer period of time, what you're going to have is increased underdevelopment of underdeveloped states. Now, that is going to be a huge political problem, which will soon make chief ministers say, no, let's go back to a system by which I can actually put something so these guys don't come in here. So, this is a skeptic's question. Please explain to the viewers why I'm wrong.
Well, because this argument could also have been used to say that there should be no free trade around the world. If you allow free trade, what will happen is that some countries will completely dominate production. And for example, India, which is uncompetitive on many fronts, would have seen a complete hollowing out of any economic activity. Exactly the opposite happened. We began to export things that we were particularly good at. That's where the IT services revolution came about. Now we're focusing and creating niches of excellence in engineering goods, or pharmaceuticals, auto products. So I think you can either argue that this is a race to the bottom or this is a race to the top, that states will compete for investment. And if you take away the tax arbitrage, which is the easy thing to do, let me give you a tax break to set up here, which is really not optimal from the country's perspective. What states will have to do is compete on infrastructure. So if states will realize that to attract investment here, I need to create better power, better roads, better access. So I look at it the other way, that if you take away the tax arbitrage and create a true common market, you will get a comparative advantage, you will get specialization, and you will get this competitive federalism, where states will have to up their game to attract the marginal dollar of private investment, and that is a good thing, both for the state and for the country.
Okay, one final question on GST, and then I'm going to go to the other macro indicators which are confusing people. And that is, we spoke to Samir Arora a couple of days back, and he said that, the GST, when it comes, it's going to have a 15-day impact on the markets. Everyone will say, wow, this is going to come soon and the markets will go up. Once that happens in 15 days, people will say, the benefits are going to come 2-3 years down the line, and the markets will then forget about GST. And actually, it'll get priced in. Do you agree with that?
Thankfully, being a macroeconomist, I don't have to worry about the impact of the GST on the market. I have to worry about the impact of the GST in the economy. Yeah. So for me, I'm indifferent to whether the market reaction is a week or a month. I think it's a good reform, and it has an impact in the medium term on the economy.
That's a good answer. All right, let me go to the other macro indicators that we've been seeing, and we've been putting that out for our viewers every day, and I can honestly say that I think we've ended up confusing everyone. Thank you for coming in, and I hope you're going to put it all in perspective. Let me start with the latest CMIE report, because that came out the first among the lot. And I know the government is contesting that report, but the report seems to suggest that existing projects which were supposed to be completed, the completion of projects is at a 10-year low. When you look at the number of stalled projects, this is Q1 of this fiscal. When you look at the number of projects which are getting stalled in terms of capex project, then it is at the highest. It is the highest since January. I think the first quarter of 2013. I might be wrong in the date, but one of the worst quarters of the UPA. In terms of new projects coming in, it is one of the lowest in the last 5 years. But on the other hand, when we look at the data which came in, the IIP data which has come in, I know it's not great, but if I take out electrical machinery, which is about 3% currently in weight in the IIT, and the original 2004 weight is about 2%, then the May number is about 3.7% and not 1.2. I'm taking out electrical machinery, as I said. The IIP numbers seem to indicate there's an uptick. The CMI report seems to suggest that no, there is nothing major happening. The report from one of the banks said that stressed assets are only increasing. Interest coverage ratio of 22% of the top 500 companies is below 1. What is the outlook? Everything looks confusing.
Yeah. So I think the first thing to realize is not, or to consider is never to overinterpret any one data point. IIP is necessarily extremely volatile. If you looked at last month's IIP number, you thought the sky was falling down in India. If you looked at this month's IIP number, even without the adjustment you made, month on month things have grown at 2%. That's an annualized rate of 24%. It's fantastic. The truth is never, there are no corner solutions in macroeconomics. It's not that things are all bad or things are all good. The truth, in my view, lies somewhere in the center. And this is how I think about growth dynamics in India. I think that even though there remain question marks on the level of GDP under the new methodology, what's been indisputable is that GDP growth has accelerated in FY16 versus FY15 by all accounts. However, the growth acceleration has been uneven and patchy. There have been pockets of growth and pockets of stress. What are the pockets of growth? It's clearly the urban consumer. Consumer durables have done well. If you look at consumer durables over the last year in IIP, if you look at auto sales and auto production, if you look at lending by banks to households, all corroborate the fact that urban consumption has done well. The other area which seems to have done well is capital goods production, but not private capex, it's more public capex. And this is because the government, both center and states, devoted many more resources to public investment. Therefore, things like commercial vehicle sales and cement production picked up. So these were the bright spots in the economy. Where we're really struggling is rural demand, both for structural and cyclical reasons, and more importantly, private investment. And this is where the other two data points you raised come up, because I think it's fair to say there still are a significant chunk of stalled projects in the economy in the private sector. Now, not all of this is the government's fault. A lot of this is because of commodity prices collapsing, steel, for example. And so a lot of the recent stress is in the commodity sectors. Some of the policy areas, things are getting better. If you look at the data in the last three quarters, stalled projects in power and real estate have gradually begun to come down. So the way I think about this is there has been a gradual pickup in growth over the last year. The biggest challenge today in India is reviving private investment. And this is where I think the banking problems come front and center. That, if you think of investment, there are two different animals here. There is manufacturing, where capacity utilization is low, and that has more to do with global demand. So if domestic demand picks up and global demand picks up, you'll see capacity utilization pick up and maybe some investment. But what I'm referring to is the huge infrastructure deficit. That even if global manufacturing demand is low, India can have 5 years of high private investment in the infrastructure space if we can sort out the leverage issues, both in the corporate sector and the bank non-performing assets. So I think the economy is a very complicated beast.
Who's going to pay for that?
We shouldn't overgeneralize, oversimplify.
I'm saying that private investment in infrastructure, let's say something like roads or bridges or whatever you talk about, or even in power, who's going to pay for the final consumption of that?
No, it has to be private. That's the key. It has to be private money here, because if you look at, there is no space on the budget. Part of the reason the government could devote more money to capex last year, both center and state, is because there was a huge windfall from oil revenues that the government got, almost 1% of GDP. That goes away. That's a one-time incremental windfall. Incrementally, the government gets nothing more in FY17, which is why you can't devote more public investment monies this year. What's been budgeted is in fact less. And therefore, the sooner we can resolve NPAs and the leverage problem in the private sector.
No, I'm asking two things. I'm asking two questions there, Sajjid. One is, why would the private sector pay for something when you can't really get revenues out of it?
Yeah.
I mean, who's going to pay for, ultimately, where will they get revenues out of? I mean, if you charge me 15 rupees per unit of electricity, then obviously I'm not going to switch on my air conditioner, right? And obviously I know that there is pockets of corporate world which are paying very high rates because of using gensets and stuff like that. But that demand again is a huge cost, right? So who's going to pay for it? Who's going to pay the toll?
No, so I agree. I think that, there are problems with the way public-private partnerships have been set up. There are both implementation bottlenecks that the government has to resolve to attract the private sector, land acquisition, who takes on the early cycle risk, so on and so forth. But it's not fair to say that none of these projects will pay for themselves. There are a whole bunch of highways that the private sector has created, both in the past and in the future, which are completely economic going forward. So at least there are certain infrastructure areas, roads and highways being in one, where if you sort out the leverage issue, you sort out the implementation bottleneck, the project itself is economic. But you need to get rid of the debt overhang to attract more money in.
The main thing still remains the leverage issue.
That's right. That for me is the binding constraint in the next 12, 18 months. That leverage in the private sector and high NPAs in the public banking system will become the binding constraint for more money to go there. Which is why if you look at credit growth, there's a huge skew. Credit growth to households is very strong, but growth to infrastructure and industry is 0% in nominal terms in the last few months.
No, but that brings me to the question that the debt actually lies on public sector banks and the investment are by private sector. And private sector banks are doing well, but they're not going to lend to these kind of projects. Why should
That's right.
It's only government intervention which makes public sector banks lend. And now public sector banks have been told, clean up your books, do this, do that. Why would they lend?
No, I agree, which is why I said that, let's not put the cart before the horse. We need to clean up our NPAs, find a way of resolving that stress. If there is a hit that the economy has to take in the next year or two, it's a hit worth taking, because that is the price you pay in the near term to create the conditions for sustainable growth in the medium term. So the faster we can, we've done a very good job recognizing non-performing assets. Now we have to find mechanisms to resolve them. And it's only when those are resolved will public sector banks have the capital and the balance sheet to be able to look at what may be economic projects. You don't need the government to push them to lend to a road project that's perfectly economically viable and say that's a good lending opportunity. Right now that's not happening because of this huge debt overhang that's created so much risk aversion among public sector banks.
Right. Can you, Sajjid, apart from this, another big important issue is what's happening at RBI. How institutionalized is the new monetary policy framework? Since the taper tantrum, macro stability and, strength at RBI or monetary policy was the key for India's outperformance. How do you see the monetary policy framework going ahead?
I think the government and the RBI deserve huge credit for a significant institutionalization of the framework. Just think back to where we were in 2013 January, and in 3.5 years, we've moved to a nominal anchor. We've got headline CPI targets. We've got numerical benchmarks that the RBI has been following. The government and the RBI signed a memorandum of understanding in 2015. Now the RBI Act has been amended. We are on the verge of setting up a monetary policy committee. These are huge institutional advances in a matter of 3 years. I think what remains is for the government to choose an inflation target. The hope and expectation is that will not change from what the government signed up to last year, which is you've got this band from 2 to 6%. I think as soon as we do that, then you've got the whole framework which is largely institutionalized. You've got a target band, you've got a monetary policy committee, and you have a legal mandate in the RBI Act. And that's the kind of institutionalization India needs on the fiscal, on the monetary. Then it's almost, I think the evolution to middle income status is, personality should be less important and processes should be more important. That, once these things are institutionalized, there should be less speculation on who the new governor is, because there will be more policy continuity almost by construction. I think that's why the institutionalization is so important. And again, I want to say again that the government and the RBI both deserve enormous credit for the leap that has happened on this front in the last 3 years.
Right. Can you just tell us that why should we have positive real interest rate? What does that do, and should we keep it at that level?
Well, we've seen in the past, right? So we don't have to go much beyond our own recent history to see what happens. Post the global financial crisis, through much of 2009, 2010, 2011, households and savers faced sharply negative real rates. And we know what they did. They voted with their feet. They abandoned financial assets. They bought gold. They bought real estate. Large purchases in gold meant that put pressure on the current account, and there were fewer resources that were available in the financial system to lend to domestic investments. You had the strange thing where household savings are high, but a lot of that saving is going towards unproductive physical assets because real rates are so negative, and then you force investment to actually go and borrow offshore and take on some more risk, and that puts pressure both on the current account and the capital account. So I think it's not so much that we need to target real rates for the sake of them being positive. I think the real rate needs to be whatever the real rate needs to be to keep inflation contained, below 6%, and that real rate will be dynamic. It will be a function of where potential growth is, where oil prices are, so on and so forth. But it's also true that if real rates are very negative, we've seen what the adverse consequences have been on the nature of household saving in India.
Right. As far as forex stability here in India is concerned, as well as the FCNR deposit which comes up for repayment, do you think that's a big risk to very volatile currency going ahead?
No, I don't. I think we need to understand that the RBI has fully covered its liabilities. Somebody in the market will have to sell the RBI dollars. Most banks who have contracted to sell these dollars forward are also hedged. Now, there is the possibility here that the end counterparty temporarily may need to roll some of these things forward. So there could be a timing mismatch of a month or 2 or 3. But I don't think that's going to create undue stress because I think there are, we're running BOP surpluses. So every month the BOP surplus will be used to repay these liabilities. And B, the RBI has got a massive war chest of reserves. So, in the worst case scenario, if there is some stress on the currency, the RBI can always dip into its reserves temporarily to smoothen pressures on the currency market, and then those reserves get replenished because the RBI in any case has completely has completely covered its liabilities in the forward market. So I don't see this as being a big risk. There could be a little bit of volatility for a few days or a few weeks, but I think if this is handled well, this should not create much stress.
Right, Sajjid, thank you so much for joining us here this morning. Always a pleasure talking to you.